truth is, most people aren't afraid of losing money. They're just afraid of watching it move. I don't trust the stock market. That sounds reasonable. Watching charts jump up and down, your heart does beat a little faster. But a savings account earning 1% a year somehow feels very safe. Maybe we're only afraid of things that fluctuate right in front of us, and the things that quietly lose value over time somehow look safer. But anyway, let's put emotions aside. Let's talk logic for a moment. So what is a stock, really? It's not a chart. It's not green and red candles. And it's definitely not a casino. A stock is simply ownership. When you buy a stock, you're buying a very small piece of a real business. That's it. To make it easier to understand, imagine this. You have a friend who wants to open a pizza shop. He needs $100,000 to get started. He has $50,000. He's short $50,000. He says to you, "Hey, give me $10,000 and I'll give you 10% of the shop." If you agree, from that moment on, every pizza that gets sold, you're not the one standing at the oven, but you benefit. That's a stock. The only difference in real life is that instead of a pizza shop, you're talking about companies like Apple, Google, or Microsoft. The logic doesn't change. Only the scale does. You become a co-owner. So how do you make money? There are two ways. First, capital gains. Go back to the pizza shop. At the beginning, the shop is valued at $100,000. You put in $10,000 for 10%. A few years later, the shop becomes popular. 5-star reviews, more locations. Now it's valued at $300,000. Your 10% is now worth $30,000. You put in $10,000, now it's $30,000. If you sell your share, you make $20,000. That's capital gains. Second, dividends. Let's say this year the shop makes $50,000 in profit. The owner says, "I'm distributing $20,000 to the shareholders." You own 10%. You receive $2,000 in cash. That's dividends. Of course, it's not always perfect. If the shop struggles, the value drops to $80,000. Your 10% is now worth $8,000. You lose money. If the shop shuts down, you could lose everything. Ownership always has two sides. But here's the interesting part. People ask, are stocks risky? Yes. But what about not investing? Money sitting in a savings account earning 1% a year, while inflation averages 2 to 3%. We don't feel the pain immediately, so we assume it's safe. Historically, over the long term, the US stock market has averaged around 7 to 10% per year. Not every year. Some years are strong, some years drop hard. But over the long run, that's the average. Savings accounts? 1 to 2%. So the real question isn't, is there risk? The real question is, which type of risk are you choosing? There's another thing. Some people trade every day. Buy today, sell tomorrow. Heart racing. News constantly updating. Very exciting. Also very stressful. Others buy good businesses and hold them for years. Sounds kind of boring. But usually, boring builds wealth. Excitement builds stories. In the end, what is a stock, really? When you own a stock, you own a piece of factories, technology, distribution systems, future profits. You participate in the economic machine. When you don't own, you simply sell your time to those machines. There's no right or wrong, just two different roles. Stocks aren't gambling. Not understanding is gambling. If you buy just because someone online tells you to buy, that's speculation. If you understand that you're buying ownership in a real business, that's investing. The rest is your choice. Thank you for watching the video. See you in the next one.